Morning. We'll start with section A. Section A of course, part 1 that talks about external financial reporting decisions. Let us see the overview. Uh, the financial statement includes number one, what? The balance sheet. Number two, income statement. In India, we call it as P&L account. For IFRS or US GAAP, they call it as which one? Income statement. Statement of comprehensive income. What is statement of comprehensive income? It includes income statement plus something called as OCI, other comprehensive income. What is other comprehensive income? We will learn. Then, in India, we call it as shareholders' funds. They call it as statement of owner's equity. Statement of owner's equity. In India, we use the word share capital, reserves and surplus. They use the word statement of change in owner's equity. Then cash flow statements are also part of which one? Financial reporting. Financial reporting includes all these things. Your, income statement, your balance sheet, statement of comprehensive income, statement of owner's equity, statement of cash, that is cash flow. We are going to classify this into operating activity, investing activity, and which activity? Financing activity, like that. There are certain aspects in financial statement which we are going to deal with. What to do for accounts receivable? Accounts receivable is nothing but credit sales, debtors, how to account for them, how to value the inventory, different methods, then different types of investments, how to record, how to go for business combinations and consolidations, fixed assets and intangible assets. Then liability side, we have got short-term liabilities, warranties, and which one? Accounting for income taxes, how to provide for leases, retained earning, common stock, preferred stock, treasury stock. Like this, we are going to learn about in and out of financial reporting perspective. So this is about the section A. This is about which one? Section A. Then let us begin with the first element. The first element, we call it as financial statement, the balance sheet. Income statement is generally prepared for a period. Income statement is generally prepared for a period. Income statement is prepared for a period, and balance sheet is prepared on a particular date. Otherwise, income statement is more like a videotape. It runs for 1 year. It records all 1 year transactions and events, like your incomes, expenses, all those things are happening for 1 year that we record. That is in which one? Income statement. But whereas balance sheet is more like a photograph. It is like a picture on a particular date. As on this date, these are my assets and liability. These are my assets and liability. That photograph will change maybe on the next day. Okay, the current assets or fixed assets or liabilities or anything that can change on the subsequent day. That is why we call it as balance sheet as on a particular date, income statement for a period, like that we call it as. So who uses this financial information? Let us begin with. Okay, you can find the list that tells you why do we use financial statement. Number one, I want to decide in which company we need to invest. Then can I give the credit or not? I'm a supplier. Should I have to offer the credit or not? Should I have to offer the credit or what? Not. Then analyzing the strengths and weaknesses within the company. Okay, if you know your financials like P&L account and balance sheet, okay, whether cost is more, or you're not able to generate revenue, are you doing a wrong advertisement, are you having unnecessary fixed assets, are you having sufficient solvency, liquidity, various aspects, okay, within the company. Remember, we are going to see SWOT analysis in section B. Strength, weakness, opportunity, and what? Threat. Strength and weaknesses are internal. My strength, my weakness, it is internal. Opportunities and threats are what? External. Okay, so we are going to see that perspective of what is the strength or weakness in the company by analyzing your financial statement. Then evaluating which one? Management performance. Sometimes income statement is prepared product wise, department wise, branch wise. We can evaluate the performance of management, and of course, determining whether or not the company is complying with which one? A regulatory requirement. That will be there in the form of notes to accounts. Okay, notes to accounts will tell both financial as well as what? Non-financial information. So these are the reasons why we use a financial statement. Clear? Decide where to invest, decide where to, withhold the credit. For example, should I have to supply the material on credit or not? We are analyzing the strength and weakness, evaluating the management performance, and whether the company is complying with which one regulatory requirements. Now, coming to multiple choice question, they can ask you questions about who are the direct users. They will give you the options. From the following, who are the direct users? Who are the indirect users? What do you mean by direct user? I'm going to deal with a company. I analyze the financial statement. I'm going to deal with the company. I'm analyzing which one? Financial statement. I'm called as what? Direct user. Okay. Example, CEO of the company, CFO of the company, shareholder, creditor, lender, employees, direct users. Okay. Who are indirect users? They represent direct users. What do you mean by represent direct users? You have money. You do not know where to invest. I will analyze and tell you where to invest. So I'm a financial analyst. Am I going to make investment in the company? No. I will analyze and give the report to you where you can invest money. Or, for example, you want to decide about whether to extend credit or not to this company. Then I'm an analyst. I will analyze and give it to you. So financial analysts, advisors, stock markets, regulatory bodies are called as what? Indirect users. Do you understand? If an investor or an employee or a creditor is making a direct analysis, they are called as direct users. On behalf of direct users, if anybody is doing the work on financial statement, they are called as what? Indirect users. Okay. A multiple choice question can be tested based on this. In the past also, a question was tested. Which of the following are not direct users, are direct users, are indirect users, are not indirect users, like that? They can ask you a positive question or a negative question. What is a positive question? In the following, who are direct users? 1, 2, 3, 4. 1, 1 and 2, 1 and 2 or 3, like that you can choose. Okay. That is a direct question, which is a positive question. Negative question is which is not. Okay. Like that, positive or negative question can be tested. Users also can be classified into internal and external users. What do you mean by internal? What do you mean by external users? Internal users make decisions within the firm. CEOs, CFOs, board of directors, key shareholders, okay, the employees, line managers, okay, those who are operating within the firm, then they are called as what? Internal users. Who are external users? So far I'm not connected to the company. In future, I want to get connected to the company in the form of indifferent way. Can I be an employee in the company? I will analyze the financial statement. Is the company growing? If I join, whether my career will be good or not. What is the profit they are making? So I'll analyze. A prospective employee is an external user. A prospective investor, I want to analyze before I invest my money in shares. I become an external user. Okay, I want to decide whether to buy the product or not. I analyze the financial statement, sales growth, brand, etc. and all. And I'm a lender. I'm analyzing the financial statement before lending. So I'm called as which one? External user. Simple. Outside the firm, whether to begin relationship, continue relationship, or change a relationship with the firm, we call it as which one? External user. It is not shareholders are internal users, lenders are external users. No. It all depends upon who you are to the company. So that is about internal and which one? External users. As I told you earlier, the financial statement will have these components. What are the components? Balance sheet, income statement, statement of comprehensive income, statement of changes in stockholders' equity, nothing but we call it as shareholders' funds. Then preparing which one? Cash flow. Preparing a cash flow statement. Preparing a cash flow statement. IFRS and US GAAP. Let us analyze and discuss. For example, US GAAP says record the asset at cost. Record the asset at cost. Indian accounting systems also will say record the asset at cost. Okay, record the revenue on accrual basis. Record the revenue on accrual basis. Okay, value the inventory at cost or market price, whichever is less. Value the inventory at cost or market price, whichever is less. These are the rules which are given by GAAP, US GAAP. So from this you can understand US GAAP is rule based. US GAAP is which one? Rule based. Rules are rigid. that cannot be changed, that is not changed over a period of time. But IFRS is more principle based. Let me tell you, for example, IFRS talks about, we are going to see in later, value the inventory at cost or market price, whichever is less. What do you mean by market price? What do you mean by market price? Cost is, let us assume, 45 million. Selling price, if I sell this, I will sell for $40 million. Okay, I have to pay a commission of 10% for selling the product. Other delivery cost will be around 5%. Now, what is market price? US GAAP says value the inventory at cost or NRV, whichever is less. What is market price? IFRS clarifies. Okay, market price, don't take market price, take NRV. NRV means net realizable value. What is net realizable value? Selling price minus direct cost of selling. So it's like 40 million minus 15%. Why 15%? Direct cost of selling. So 85% will be the net realizable value, because 15% goes for expenses, 85% becomes NRV. So cost is 45 million. Okay, this is 34 million, whichever is less. That is IFRS. IFRS is more to do with which one? Principles, and guidances are given in applying the principles. For example, we tell record the income on accrual basis. What do you mean by accrual basis? Due basis. I sold the product to you on credit. Can I record the sales? Yes, I can record the sales. But this is a US GAAP. Let us assume you are purchasing a product in Amazon. Let's assume you paid the money on 1/1/2026 and you place the order for the product. The product was delivered on 3/1/2026. Okay, you place the order. I'm the seller. Okay, through Amazon I'm selling. You place the order for $4,000. I delivered the product on 3/1/2026. Okay, which is having 7 days replacement by Amazon. Then, when the revenue will be recorded by me? You paid the price in the Amazon website, $4,000. I delivered the product on 31/2026, where 7 days replacement performance guarantee or replacement guarantee is given by Amazon. Seller, when he will record the income? First order itself, we will record the income. You just place the order. I am made to do my duty. I have not delivered the product. Product is still with me. On 1st January, you just place the order. Did I deliver the product? No. Is it due? Accrual? No. Whether I have collected the cash? No. Who collected the cash? Amazon has collected the cash. If I don't deliver the product, will they give me the money? No. So, can I record the income on 1/1/2026? No. Can I record the income on 3/1/2026? No. Why? Customer has the right to replace or return or something like that within how many days? 7 days. So from 3/1 plus 7 days now, 10/1/2026 only accrual happens. Simple. US GAAP is not telling about it. US GAAP tells only one thing. What it tells? Record the income on what basis? Accrual basis. Over. But US GAAP is telling like that. IFRS gives a clear-cut interpretation. What is the meaning of accrual? They have given definition also. If substantial risks and rewards are transferred to the buyer, and seller is not having any control over the goods. Seller is not having any control over the goods, and there is no contingency in recovering money. Like this, interpretations are given by, guidances are given by which one? IFRS. I'll give you one more example. I'm doing a contract work for you, which may be construction of a commercial building, like your office building. The work will take place for 3 years. 3 years, 50 million. value of the building is 50 million. The work will be done for how many years? 3 years. At the end of first year, I want to know the profit or loss. Is the work complete? When will I know the actual profit or loss?
Yes.
Only after 3 years. Only after 3 years. But I want to know the profit or loss in the first year, second year, or third year. What to do? Your US GAAP will not tell anything. US GAAP told only one rule: recognize income on accrual basis. But IFRS will guide me how to recognize contract, long-term contract with customers like that. So that is what. So that is about IFRS and which one? US GAAP. Okay. Now let us move on to the balance sheet. As I told you, balance sheet is for a period or at a point of time. At a point of time, as on this particular date, as on this particular date. It will give you assets, liabilities, balance will be called as equity. Assets minus liability, we call it as which one? Equity. In India, assets minus liability, we call it as capital. Okay. So in balance sheet, what you can expect? What is the first one? Liquidity. What do you mean by liquidity?
Cash.
Ability to convert into cash. Okay. Are you having convertible assets or non-convertible assets? Example of convertible assets into cash? Cash at bank is most liquid. Then
Gold.
gold. But why a business should keep gold? Okay, I'm telling you. Investment in various assets. Investment in debentures, investment in bonds, investment in shares. Listen, in that investment also, certain investments are subject to lock-in period. 3 years you cannot sell, 4 years you cannot sell. You cannot transfer like that, it will be there. So investment itself can be classified into at any time you can get the money, or at any time you can get the money, or you can get the money only after what? Certain period of time. Long-term investments like that you have to classify. So if you look at financial statement, the first one is a company's ability to convert the assets into cash and pay the obligations. Remember, there are two types of liquidity. One is called as long-term liquidity, another one is called as what? Short-term liquidity. What is a long-term liquidity? I will give you a loan for 5 years. After 5 years, will you be able to repay the loan to me? Checking this called as long-term liquidity. Are you having fixed assets? Are you having fixed assets? How much of loan already you are having? Let us assume fixed assets are like 200 million. Already you are having a loan of only 30 million. Can I lend you? Yes. 200 million assets are there. Only 30 million long-term loans are there. If I lend you, yes, definitely your company will repay. On the other hand, 200 million fixed assets are there. Already you borrowed 180 million. Can I give you a loan now? 200 million, 180 million, 90% loans are there. Small decline in the value of fixed asset, then you will become bankrupt. So you can check long-term liquidity. Long-term liquidity, number one. Number two, what is short-term liquidity? I supply the material to you. Will you be able to pay the money on time? For example, I supply the material to you. You promise that you pay the money in 30 days. Okay, will you be able to pay? I will check your current assets and current liability. Are you having sufficient working capital? Are you having sufficient cash balance? In the past, how many days you took to pay? So liquidity can be both long-term as well as what? Short-term liquidity. Analyze, then do it. Who will do it depends upon who you are. If you are giving long-term loans, if you're investing in long-term bonds or preference share capital, things like that, you look into long-term liquidity. If you are supplying material or rendering service to my company or giving a short-term loan to my company, you will look into which one? Short-term liquidity. That is the first one. What is the next one? Financial flexibility. Financial flexibility. I'm having a cash flow problem for next 3 months. My company is having a cash flow problem for next 3 months. Will I be able to run my company? Yes, no, you are financially flexible, Nartho, which means you can convert your investments into cash and run, or take a loan and run, or take a long-term loan and run. Flexibility means ability to utilize the opportunities or problems or counter the problems, that we call it as what? Financial flexibility. Right? For example, no cash flow is going to come for next 3 or 4 months. How are you going to solve? Yes, we can borrow. We have got ability to borrow. We have got investments we can sell and get the money. You are financially flexible. Already you are having very higher borrowing. Assets are not saleable. Then you are not flexible. You are not financially what? Flexible. Okay. So financial flexibility can be tested. What is the next one? Solvency means whether the company will be able to pay the long-term obligations. Clear? You are having assets, you are having long-term liabilities. Will you be able to repay? Will you be able to what? Repay. What is the next one? Risk. Okay. Unpredictability of future events, transactions, circumstances that can affect the company's cash flows and which one? Financial results that can be tested by analyzing your balance sheet. Pay attention. For example, I am a director of a company holding 70% of shares. Remaining 30% are outside shareholders. Okay. Now what happened is, to take the loan for the company, I pledge the share and take the loan. I pledge the share in the market or in the bank. I have taken the loan. Okay. Is it risky or not risky? It is risky. Pledging director's share and taking a loan is risky. Maybe you could have seen Coffee Day. The owner committed a suicide. Okay, the MD committed a suicide. The reason is he pledged the share and took a loan of 1,500 crores. Okay, at the time market value of the shares. Example I am telling, actual results are different. Market values are like 2,000 crores. Okay, you just took a loan of 1,500 crores, pledging the shares having a market value of how much? 2,000 crores. What happened is, there is always something called as financial frauds, financial bullying takes place in the market, internationally also. There was notice sent by GST department to Coffee Day, notice from income tax department, notice from legal department were sent. What happened is the market value of the share came to 1,200 crores. Market value of the share came to how much? 1,200 crores. But how much you borrowed? Now the banks will ask for additional security. Already you have pledged the shares and taken the loan. What additional security can give? No. Will you be able to sell the shares in the market? No. Why? Because they are pledged. Without repaying the loan, you cannot get back your shares. Then other people stopped dealing with the company. Looking at this negative news, other people stopped dealing with the company. So what happened is the business got disrupted. Of course, they revived later. There is a different one. It went to the event of even the MD of the company, the founder of the company committing suicide kind of a thing. So this you can see or predict the risk by looking at which one? Financial statement, note to accounts like that. Please remember, balance sheet accounts are permanent accounts. See, we are going to prepare income statement and which one? Balance sheet. Okay, here we are going to record incomes are matched with which one? Expenses. They are called as temporary accounts. They are called as which one? Temporary accounts. Why? Salary, rent, director's salary, sales, purchases. Are they carried to balance sheet or closed in income statement? Year to year it will be closed in income statement. Will they continue in balance sheet? No. So incomes and expenses, income statement is more like which accounts? Temporary accounts. Balance sheet you can find even accounts receivable, accounts payable, or let it be plant property equipment or investment or loan. It will have a continuity. It will have a continuity from this year to next year. It can be receivable or what? Payable. So in the balance sheet you can find permanent accounts will come. Permanent account means the accounts that will continue from year to year. For example, you are my customer, I supply the product on credit. Whether the relationship is closed in 6 months or it continues year to year. Year to year it will continue. So year to year the account ledgers will keep on continuing. That is about balance sheet. That is about which one? Balance sheet. What are the elements of balance sheet? What is the first one? Assets. What are assets? Don't look at the formal definition. What are assets?
Anything that gives a future.
Simple. Anything that gives you what? Future benefit. How do you get that asset? Through the past transaction. Through what? Past transaction. That is what? through the past transaction presently owned by the company, it will give us what? Future economic benefits. Clear? So it's clearly defined past transaction. It can be purchase or construction like that. Presently owned by the company. Presently owned by the company. It will give us what? Future economic benefits. Okay. If you do not own, you cannot record the asset. If there is no future economic benefit, then you will not record the asset. You will scrap it or you will write off in P&L account. Likewise, what is a liability? It arises from which one? Past transaction. I purchased goods from you on credit. I took a loan from you. I borrowed money from you. Or you rendered my services, I have to pay the money. Past transaction. Presently, owed by the company means payable by the company. It will result in future sacrifice of economic benefits. I have to give you cash or cash equivalent to settle the liability. So assets are like future economic benefits. Liabilities results in what? Sacrifice of which one? Future economic benefits. Assets minus liability, we call it as which one? Equity. Assets minus liability, we call it as which one? Equity. Then assets are further classified into current and which one? Non-current assets. Sir, what is a current asset or what is a non-current asset? Gets converted into cash within one operating cycle. Please remember, it is not within 1 year. It is called as one operating cycle. What do you mean by this? Normally in India, we call it as current assets are convertible within 1 year. Operating cycle generally 1 year. But it can be more than 1 year. Is it possible? Example. For example, I purchase fireworks, crackers and sell 3 months, 4 months. I purchase merchandise like shirt or a t-shirt or garments and sell 2 months, 3 months. I purchase, manufacture medicines and sell 1 or 2 months. I manufacture chairs and sell. I manufacture today, I may sell it within 1 month like that, 1 or 2 months. Okay, I manufacture laptops and sell it 2 or 3 months, maximum 3 or 4 months. That is, all these things comes within what? One operating cycle, one financial cycle. I have an inventory. Why do I call it as current asset? I will sell it within next year. I will call it as accounts receivable, debtors. I will collect the money in 1 or 2 months. When operating cycle will be more than 1 year? Can you give me an example of a business where operating cycle will be more than 1 year? Live online, friends. Raw material also, for example, to manufacture the chair, I purchase plastic and other materials. Okay, that raw material is consumed within 1 year. I have a raw material inventory on 31st March. It will be consumed in April month or May month. 2 or 3 months only it will take. I purchase rice, paddy or wheat, etc. and all. I convert into flour and sell them within 2 or 3 months of time. I will not hold it for 2 or 3 years. Raw material, work in progress, finished goods, inventory, trade receivables, cash, all these things. Gold, gold is a fixed asset, a kind of fixed asset. No, business perspective analyze பண்ணலாம். A company will not invest in gold. A company will not invest in gold because it's a non-operating asset for them. They will invest in what? Operating assets like plant, property, equipment. That is a fixed asset. Current asset having more than one operating cycle. Live online, friends, respond. Yes, please. You can respond. In case of wines, breweries, etc. and all, now they take more than 1 year time. Maybe you could have found certain malted whiskies. They are manufactured in 2015, kept as stock, and sell in 2025. Manufactured in 2015, they call it as 10 years old bottle. 10 years old bottle. They sell it at a very high price. They sell it at a very high price. Maybe if you look at the inventory is kept for what? 10 years. Inventory is kept for 10 years. Still it will be called as current asset. Still it will be called as what? Current asset. Maybe petrol is, of course, it's like 3 months, 4 months time. Extract, they sell it in 3 months, 4 months time. There is a famous brand in Australia called as tequila. They manufacture and keep in stock for 30 years. Inventory is kept for 30 years. They manufacture it today. It will come for sale after what? 30 years, which means 30 years is their operating cycle. So operating cycle can be more than accounting year also. One more example, let us assume I am constructing and selling apartment. I am constructing and selling apartments. The apartments are fixed assets for me or current assets for me? I buy a land, I spend money on construction, thereafter I will sell them. Okay, is it a fixed asset for me or current asset for me? For me, it is a current asset. I am a construction company. The land and building under construction or constructed building is a current asset for me. Is it possible to complete all the work within 1 year and finish everything in 1 year? It may take 2 years, 3 years, 4 years time. So sometimes there may be more than 1 year operating cycle for them. Till that operating cycle is complete, it will be called as which one? Current asset. So what is operating cycle? The business cycle. Raw material to manufacturing to finished goods to selling and collecting the money. Generally, it will be what? 1 year. Normally, it will be 1 year. Okay. In certain special cases, it can be what? Beyond 1 year also, like construction, wine, breweries. The operating cycle can be what? More than 1 year. Then that is what? Cash and other assets reasonably expected to realize in cash during normal operating cycle of the business. Clear? Normal will be within a year. Normal is within which one? A year. But however, sometimes it can be more than 12 months, like tobacco, distillery, lumber business. Longer period can be there. Longer period can be there. So what are all included in current assets? Okay. What is the first one? Cash. What is cash? Cash in hand, cash at bank. Cash in hand and what? Cash at bank. This also includes undeposited checks. For example, a student has given a check on 31st March. We have not deposited the check in the bank. It will be deposited in April month. So as on 31st March, it is called as equivalent to cash or cash. It includes coins, currency, and also includes what? Includes the money transfer, stamps, and demand deposits. All these things are called as what? Cash. What is the next one? Cash equivalent. 1 minute. What is a cash equivalent? Any deposit, any investment made with less than 3 months maturity, that we call it as what? Cash equivalent. For US financial reporting purpose, what is called as cash equivalent? I invested the money today. Within 3 months, the money will come to me. It can be any investment. Short-term deposits. It can be fixed deposits or fixed deposits made for 3 months period. Okay. So 3 months or less, it will be called as which one? Cash equivalent. Let us come to a question. Look at this question. This is the date of deposit. This is the final accounts date. This is the date of maturity, and this is the amount deposited. Tell me what is a cash equivalent. I highlighted the answer, but still. See this one, 1/10/2025, 5/1/2026. It is more than 3 months. 1/11/2025, 1/10/2026. From the date of deposit, date of maturity you have to see, not from final accounts date. See, final accounts is on 31st December. Just 5 days it will come. It is not cash equivalent. Okay, from the date of deposit till the date of maturity, you have to see and find out. It is deposited on 15/12. It is maturing on 15/2. If you look at it, is around 2.5 months. 31/12, 10/4. More than 3 months. More than 3 months. So what comes within 3 months? Only this third one comes under cash and cash deposit. That's what. Date of investment or deposit to date of maturity should be what? 3 months or less. Please take up this also. Please take up the example of cash equivalent. This can be tested in multiple choice question. Don't see from final accounts date. See from the date of deposit to which one? Date of maturity. So cash includes cash in hand, coins, currency, cash in bank account, undeposited check, uncleared checks, all these things are included in cash. Cash equivalent, investments and deposits having less than 3 months maturity, having less than 3 months maturity. Two minutes, I'll just join. 2 minutes. Are we taking this over? Over. Next. Marketable securities also can be classified as which one? Current asset. What is marketable security? What is marketable security depends upon the intention of the management. You have invested in the shares of Microsoft. Will it become a long-term investment or short-term investment? Depends on the management's investment intention. Okay, they want to buy and sell whenever there is a profit. Sell and buy and sell whenever there is a profit. It will become which one? A marketable security. You are investing and planning to hold for a longer term. Then that will become what? Non-current investment. So securities, will they become current asset or non-current asset? Depends on what? Management intention. Shares, investment in shares, is it a fixed asset or a current asset? Depends upon your intention. What is the next one? Receivables. I rendered service or I supplied a product, yet to collect the money, that we call it as which one? Receivables. They are collectible in the ordinary course of business. Collectible in the ordinary course of business. Contract assets. What do you mean by contract assets? No, that's not. That is not a. Contract asset. That is not a kind of contract asset. Okay. I have created an asset. I have created an asset that is for sale. That is for sale to the customer. That is called as what? Contract assets. Then short-term notes receivable. We call it as in India, bills receivable, bills payable. A bill is written on your name, that you agree to pay me the money within what? 2 or 3 months, that we call it as what? Current asset. Bills receivable. Inventories, all types of inventories in the ordinary course of business, raw material, work in progress, finished goods, or consumable stores, everything are part of which one? All are part of which one? Inventories. What is the next one? Expenses paid in advance. Expenses paid in advance. For example, salary advance paid, rental advance paid, all those things we call it as which one? Prepaid expenses. Then, let me to go for some examples. Rental advances are not current assets. Why? For this building, I paid a rental advance. Can't have a security deposit or rental advance. It is not a current asset. Why? When will I get back the rent of that advance?
Only when the building is finished.
Only when I vacate the building, I will get the rental advance. So will I get it in within one operating cycle? No. So it becomes which one? Non-current asset. For example, for this building, we paid advance somewhere about 20 years back. To the landlord, we paid the advance about 20 years back. So when will we get back that advance? Only when you vacate the business. Clear? That is not a current asset. Salary paid in advance is a current asset. Insurance paid in advance is a current asset. Any caution deposit for a building rented or security deposit given to open lockers are which one? Non-current assets. Because the purpose or the principle of classifying into current and non-current depends on convertibility into which one? Convertibility into cash within one operating cycle. So rental advances and these two are not convertible into cash within one operating cycle. Otherwise, they are like permanent assets with you. They will be there as long as you continue business or run business. Please note this also. They can ask you, they can give you classifications like this. Maybe they can give a question like this. They will ask you identify which is a current asset, which is not a current asset, like that. They can give a question like this and they ask you to find the odd one out. Rental advance, salary advance, caution deposit, security deposits, all will look similar. But salary paid in advance is a current asset. Others are which one? Non-current asset. And please remember, look at this example. You maintained in current account a balance of 10 lakhs dollars. 2 lakhs is to be maintained minimum. What is the minimum balance required? 2 lakhs. You cannot use this 2 lakhs. You cannot use this 2 lakhs. Balance 8 lakhs only you can use it. Only this part will be called as what? Current asset. This is called as restricted cash. This is called as which one? Restricted cash is not a current asset. Any doubt in it? The cash that cannot be used in short term, restricted for usage, we cannot call it as current asset. Then the remaining, of course, we can call it as which one? That is what. Current assets also include funds that are restricted for current purpose. What do you mean restricted for current purpose? Sir, I'm keeping a fixed deposit of 10 million. I'm keeping a fixed deposit of how much? 10 million. In the 10 million, Okay, 2 million is reserved for working capital. 2 million is reserved for working capital. Now that 2 million will be called as what? Current asset. Okay, any fund that is restricted to be used for what? Operating purpose within 1 year, we call it as which one? Current asset. So from this, current assets which are convertible into cash within what? One operating cycle. Cash, cash equivalent, marketable securities, receivables, contract assets, then short-term notes receivable like bills receivable, inventory, prepaid expenses, funds that are used for what? Current purposes. So what are non-current assets?
More than uh,
Beyond one operating cycle. Beyond one operating cycle. This is what we had seen. Restricted cash is not part of which one? Current asset. That is part of which one? Non-current asset. Best example is we had seen here. Here, this 2 lakhs will be called as which one? Non-current asset. Only 8 lakhs will be called as which one? Current asset. Then any bonds, etc. and all, okay, that we are not going to use it for current operation. Okay, so we are going to keep it for long term. We are going to keep it for which one? Long term. Then long term investments and advances given. Plant, property, equipment, leases, any intangible assets like goodwill, patent right, copyright, etc. and all. I told you this, long-term prepaid expenses. Long-term prepaid expenses. Then they are not expected to be converted into cash within 1 year or one operating cycle, whichever is what? Longer. Okay. Example. Example for that. Can you
long term.
there is a problem. 1 minute. Am I audible? Screen is visible. So, contract assets that are not expected to be converted into cash within 1 year or one operating cycle, whichever is longer. Example, I sold a stock to you and I told you to pay the money in installments like 3 months, 6 months, 12 months, 24 months, like that. I asked you to pay the money in installment. Installment that are repayable by you beyond one operating cycle, that is not called as what? Current asset. For example, I sold my regular product to you for, let us assume, 2 million. I told you pay 50% now, 50% after 1 year with interest, etc. That remaining 50%, I cannot call it as what? Current asset. I cannot call it as current asset. Then surrender value of life insurance policy. See, simple. Companies take insurance on key men, that is CEO, CFOs and all. Okay. Only when you surrender the insurance policy, you will get the money. On the maturity, you will get the money. Or if employees die, you will get the money. Okay. But surrender value is, what do you mean by surrender value? Insurance policy is taken for 20 years. You want to surrender in 5 years and get the money. That 5 years, what is the value you will get? That is called as which value? Surrender value. Are you going to surrender? No. So that is not called as current asset. That is called as what? Non-current asset. Okay. So any long-term receivables, long-term repayments, prepaid, restricted cash, etc. and all, that is part of which one? That is part of your non-current assets. Okay. Then plant, property, equipment are called as non-current asset. Example of plant, property, equipment. See, elaborately we are going to discuss about these things later. Okay. What is plant, property, equipment? For Bharadwaj Institute Private Limited, what is a plant, property, equipment? Laptop, maybe ring lights or even camera or the chairs, benches, air conditioners, okay, the tables, benches, whatever you call. Clear? They are part of which one? Plant property equipment. Okay, this will include land, building, machinery, furniture, leasehold premises, any asset obtained by lease agreement. We are going to see there are two types of lease: operating lease, financial lease. We are going to see this. Then any natural resources such as gas, minerals, timberland, granite quarries, mines. All those things will be a part of which one? Plant property and equipment. Then it can be intangible long-term asset. What do you mean by intangible long-term assets? No physical substance, but it will give you long-term economic benefit. Example, goodwill, patent right, trademark, copyright, recipe rights, franchisee rights, all those things comes under which one? Intangible long-term assets. So we had seen asset classification. Asset classification, we have got current assets and which one? Non-current asset. More than the name, the principle that you have to remember is anything that is realizable or convertible within one operating cycle. Within one operating cycle, generally 1 year, that will be called as what? Current asset. Beyond that one operating cycle or 1 year, we call it as which one? Non-current liability. Same way, any obligation that is payable within the one operating cycle, we call it as current liability. Example, amounts payable for suppliers for purchase of goods or services. Creditors, bills payable like that. Cash dividend declared. Cash dividend declared. It is payable. After the AGM, you have to pay. Within 30 days, you have to distribute the cash dividends. Yes, cash dividends are part of current liabilities. Then any contract liabilities that we have to pay within short run. Any contract liabilities that we have to pay in what? Short run. Then deposits received from customers such as security deposit for lease, any agency collections, like TDS or even sales tax withholdings, all those things. Then obligations payable on demand, short-term notes like bills payable in 30 days, 60 days, 90 days like that. Next is what is most important. All these things you'll understand easily. Okay, contract liabilities, any deposits customers that is received from customers, employees taxes withheld, then obligations payable on demand, you will understand. Short-term notes also payable in short-term, you'll understand. What is this? What is the next one?
Current portion.
Current portion of a long-term debt. What is the meaning? We are on 31st December. We are on 31st December. We borrowed 10 million. We borrowed 10 million. We promised to pay 1 million once in 6 months. What is the loan on 31st December? Okay, it is repayable once in 6 months, which means the repayment will take place 5 installments on the money. Next installment will come on 30th June 2026. About we have to pay about 1 million. Then next installment will come on 31/12/2026, 1 million like that. Then others will come like 1 million, 1 million like that. It will come in the future years. So out of 10 million, these two are payable within next 1 year. Within next 1 year. So this 2 million will be called as current liability. What is the total loan? 10 million. In that 2 million will be called as what? Current liability. Why? Because the long-term debt, but the portion that is payable within what? Next 1 year, we call it as what? Current liability. The remaining 8 million will be called as what? Non-current liability. Let's assume balance sheet is prepared on 31/12/25. Okay. A company issued debentures on 1/1/2015, repayable on let's assume 30/6/2026, $20 million. Will it be called as a current liability or non-current liability? We issued debentures in 2015. It is repayable on 31/3/2026, 20 million we need to repay. We are preparing balance sheet on 31st December 2025. Will it be called as a long-term liability or a short-term liability? Think. When are we preparing balance sheet? 31st December. When we have to pay? Within how many months? 3 months. It will be called as what? Short-term current liability. So don't see when it was issued from the end of the financial year when it is repayable. When it is repayable. So balance sheet was given on 31st December. So this debenture will be called as what? Current liability. It will be called as which one? A current liability. Suppose if these debentures are repayable on 2027 now. No, we are on 31st December 2025. Is it repayable within 1 year? It is repayable what? Beyond 1 year, it will be called as what? Non-current liability. That is what? Current portion of long-term debt or lease liabilities that are payable due within operating cycle, usually what? 12 months. Any taxes payable, outstanding wages, etc. Any long-term obligations capable in the balance sheet due to some violation of law. Pay attention. I borrowed money on 1/1/2024. $30 million. For purchasing plant property equipment, I took a loan. What is the purpose of taking the loan? To purchase which one? Plant property equipment. Loan is repayable on 31st March 2032. We are preparing balance sheet on 31/12/2025. This loan will be called as a long-term loan or short-term loan. What is the balance sheet date? 31/12/25. When the loan is repayable? 2032. From now, 7 years time we have. Is it a non-current liability or current liability? Non-current liability. It will be called as which one? Non-current liability. Let's assume on 15/12/2025, okay, the bank sent a notice. Bank sent a notice. What notice? The bank said you borrowed the money for purchasing plant property equipment. How much? 30 million. But you didn't use the money for that purpose. You used the money for the purpose of repairing the plant or buying some other property. Loan said, the bank said, since the loan is not used for the purpose. What is the purpose? To buy PPE. But you have not purchased. So bank sent a notice, you violated the condition. You repay the loan within 30th March 2026. They send a notice. Now what will happen? You violated the condition. The bank served a notice telling that you repay the loan within 30th March. It will become a current liability. It will become which one? Current liability. That's what. Long-term obligations capable of in the balance sheet date. Callable means payable on the balance sheet date due to what? Violation by the company. Violation by the company such as what? Loan covenant means the conditions attached to the loan. Conditions attached to the loan. Then any assurance type warranty. Any assurance type warranty. What do you mean by assurance type warranty? Let's assume a customer purchased a laptop on 31/12/2025. The customer has paid. Let's assume $1,000 for laptop. Okay, it includes 1 year assurance warranty. Which means when the warranty will expire? Okay, so assurance type warranty is given till 31st December 2026. Now we are preparing balance sheet on 31/12/2025. Now this assurance type warranty, estimated cost based on the past behavior is like $150. This will be called as a current liability or non-current liability. 1 year warranty only given. Warranty expires within the next financial year. Warranty expires within the next financial year. So estimated cost of warranty will be called as which one? Current liability. Will be called as which one?
Correctly.
Current liability. Let's assume we have sold with 2 years warranty. 2 years assurance warranty. The warranty will expire on 31/12/2027. Okay. Estimated cost is $220. $220. How will you call this?
Non-current because more than balance sheet.
Will it be called as non-current? Yes. If the warranty extends only to the next accounting period, then it will be called as what? Current. Okay. And if the warranty is going beyond 1 year, it will be called as which one?
Non-current.
Non-current. Okay. I'll give you one example. A customer purchased a laptop on 31/12/2024. Okay, 23. 3 years assurance type warranty given. 3 years assurance type warranty given. When the warranty will expire? So, on this date, as on the balance sheet date, how will you call this as?
Current.
From balance sheet date to end date of assurance type warranty, it is what? Less than 1 year. It is less than 1 year or within 1 year now. It will be called as what? Current liability. Though it is given for 3 years, we have to see the balance sheet date to the warranty expiry date. Warranty expiry date. Here, it is though it is 2 years warranty, we call it as non-current liability. We call it as which one?
Non-current.
Non-current liability. Why? Because it is beyond 12 months. Beyond 12 months. Here it is what? Within
Well,
the next financial year. The warranty claims or estimates comes within what? Next financial year. So short term or long term is based on balance sheet date and warranty expiry date. Balance sheet date and which one? Warranty expiry date, and not for the total period for which the warranty is given. Okay, don't say 1 year, 1 year warranty na current liability, 3 year warranty na non-current. No. From the balance sheet date to the warranty expiry date, you have to see to classify this into what? A current liability or which one? A non-current liability. Okay. So current liabilities do not include debts to be paid out of the funds classified as non-current. What is the meaning of this? Current liability do not include debts to be paid by funds in accounts classified as which one? Non-current. Listen, I borrowed from you 20 million for 6 months. I borrowed from you 20 million for 6 months. Okay. As on the balance sheet date, the amount is payable, that 20 million is payable on, let's assume 30th June 2026. The 20 million is repayable on what date? 30th June 2026. We are preparing balance sheet on 31/12/2025. In general, this will be called as current liability or non-current liability. Current liability. Why?
31.
Payable within the next financial year. Payable within the next financial year. But this 20 million, okay, I will borrow long-term loan of 80 million and repay this 20 million. No?
60 million becomes long term.
No, everything will become long-term. Why? Because this 20 million, are you going to pay out of short-term funds or out of long-term funds? Long-term funds. So entire 80 million will become what? Long-term funds, and this 20 million will be called as which one? Non-current liability. That is what? Debts to be paid funds and accounts classified as which one?
Not
Non-current. Or I will issue equity shares and repay this. I will issue shares and what? Repay this now. This will be called as what? Non-current.
non.
Do you understand? 20 million repayable on 36, balance sheet on 31/12 now, it should be classified as current liability. But if you are going to take a long-term loan and repay this now, that is called as what? A current liability. Then the portion of short-term obligation intend to be refinanced with which one? Long-term obligation. Let's assume we are preparing balance sheet on 31/12/2025. That day we are having a bank OD of 30 million. How this will be called in general? Current liability. Current liability. Bank OD is called as what? Current liability. Normally payable in 3 months, 6 months time. Now what we are going to do is we apply it to the bank. We apply to the bank and convert the bank OD as long-term loan. We applied to the bank and we are going to convert this bank OD as which one? Long-term loan. Now whether the bank OD will be called as current liability? No. Why? It will be converted into a long-term loan. It will be paid after 3 years, 4 years, 5 years. That is what is this point. The portion of short-term obligation intended to be refinanced with which one? Public obligation, subject to the fulfillment of conditions. Okay. See, bank overdraft can be adjusted with bank balance, provided you are having the same, same bank account vachirunda. Sir, there is a bank balance, there is a bank OD, you can net it off and show. If there is a positive balance asset, this is a negative balance liability. That's it. What is a non-current liability?
More than one.
More than 1 year. So contract liabilities classified as non-current, more than 1 year. Long-term loans payable, like more than 1 year. Then long-term portions of long-term debt, pension obligations, deferred tax liabilities, any non-current portion of what? Assurance type warranty. This one. So we discussed about what is a current asset. Simple principle. See, all these things you cannot remember. Simple principle, one line principle that you have to remember is current or non-current depends on what?
Accounting year.
Accounting year or operating cycle. Accounting year or what? Operating cycle. Okay. If the asset or liability gets converted or becomes payable within one operating cycle or within 1 year, na, current liability or current asset. If it is more than 1 year, na, it will be called as what? Non-current asset or non-current liability. Okay. Pay attention. We made investment during 2020 for $20 million. Okay. It was kept as long-term investment. Okay. On, let us assume 20th November 2025, we started trading with that security. So as on 31st December 2025, that is balance sheet date, this investment, will it be called as a long-term investment, non-current asset or current asset?
Current asset.
Why? Because when we invested money, it was long-term investment. But during the current year, we started trading, means buying and selling. That becomes a current asset. That becomes which one? Current asset. So these 4 or 5 pages, how to remember in mind? Within 1 year, within one operating cycle, current. Otherwise, it is what? Non-current asset. For example, they have given you, in an exam question, fixed deposit made on 36/2012 or 2020 for 10 years. On 25/12/2025, the management decided to use this for working capital purpose during 2026. When is the maturity date? 2025, 30 June 2030. 30th June 2030 will be the maturity date. But on 25/12, we decided to use this for working capital purpose. Now, whether this fixed deposit will be called as a non-current asset or current asset. When you prepare a balance sheet on 31/12/2025, whether this deposit will be called as current asset or non-current asset.
Current asset.
Will be called as what?
Current
Asset, because we are going to convert this into cash within what? Next one financial year now. That will be classified as which one? Current asset. So no need to remember anything. Only thing that you have to remember is the period. Within 1 year or within one operating cycle, current asset. Beyond that, it is called as what? Non-current asset. Okay. So what is the time now? 8:20. Okay. So we'll go for a break. Like breakfast break and where we'll start by somewhere around 8:45, 8:50. 8:45, 8:50, 9 o'clock. Okay, 9 o'clock sharp we'll start. Where we'll deal with which one? Equity. Before we continue the next session, let me to give a small example. In India, what is the word we use for share capital of the company? We call it as which one? Share capital. No. In US, they use the word stock. They use the word which one? Stock. In India, we call it as equity share capital. We call it as preference share capital. Okay. That is in India. In US, they call it as common stock. They call it as preferred stock. Okay. In India, when you issue the shares more than the face value, face value 100, issued at $250 now, this will be extra money will be called as what? That 150 is called as which one? Securities premium in India. Share premium. But in US, they don't use the word securities premium. They call it as APIC. What is APIC? Additional paid in capital. Paid in capital. Terminology difference is there between Indian accounting system and of course US GAAP and IFRS. Okay, so when you issue shares more than the par value, face value, in India we call it as securities premium. In US they call it as which one? Additional paid in capital. For example, when you earn profit of, let us assume 30 million and keep it without doing anything, we call it as P&L account. In India, we call it as which one? Yeah. P&L account. In US, they call it as retained earnings. Retained earnings. We earned a profit and keep it in P&L account. That is P&L account balance. That's it. But in US, they call it as which one? Retained earnings. In India, when you buy back your shares, when you buy back, nothing but a company purchasing its own equity shares. A company purchasing its own equity shares. We call it as buyback. In US, they call it as treasury stock. Okay. So, common stock means equity share capital. Preferred stock means preference share capital. If you issue the shares more than the face value, that is called as what? Additional paid in capital. Then, if you earn a profit but don't distribute, that is called as what? Retained earnings. Buyback, a company purchasing its own shares. There in US, they call it as which one? Equity. Yes. In India, we use the word shareholders' funds. It is called as statement of changes in equity. So all these things we learn after the breakfast break. Okay, how to prepare the statement of change in equity, we are going to learn after the break. So by the end of the class, today's session, what and all we learned?
Share.
Balance sheet, direct indirect users, external internal users, properties of balance sheet. Then what and all will come under current assets, non-current assets. What and all will come under what? Current liability, non-current liability.
Equity.
Then assets minus liability, we call it as equity. How to prepare notes to accounts for equity.